Good evening, everyone. A very warm good evening to all of you. So we will start in couple of minutes. Let's wait so that others can join as well. Today, probably there was a 5-minute delay because of some technical glitch. But no worries, we'll finish it off in time. So the topic for today is cost. Good evening, everyone. A very warm good evening to everyone who has been joined. Topic is cost of capital. Let's wait a couple of minutes. Let's wait so that others can join as well, and then we will start. Good evening, GA. Good evening, KK. Good evening, AP, NS, GS. A very good evening to everyone. Yes, the class has started just now. The topic has not been even started yet. I have just named the topic, that is cost of capital. And now we will be starting with the session. Yes, we are completed with asset management and mutual funds. So if you guys allow, shall we start? Perfect. Very good, Ritik. Glad the class would be very happy to learn from you as well. So if you have any insights about the market, please feel free to mention that in the chat box so that I can share it with the class. Okay. Okay. So yes, please ask Ritik. Yeah, today we will be starting with the new topic, cost of capital. Someone is asking some doubts from the last class, that is, please explain the defined benefit plan of pension funds once again. So when it comes to pension funds, we were discussing about two plans. One is defined benefit plan, and the other one was defined contribution plan. In a contribution plan, the employer's contribution is defined. It means every month the employer will contribute some money to the pension account, and based on that, he will run a pension fund. But in a defined benefit plan, the owner has to guarantee. Yeah, Ritik, I'm coming to your doubt. Just give me a second. I guess you're talking about your counselor. Just give me a second, Ritik. I'll get back to you. Defined benefit plan. Okay, so in a defined benefit plan, the future benefits are predefined by the employer. What can be these benefits? Like pensions. In case of Army, Navy, Air Force, in case of defense sector, the pensions are defined It means that after retirement for particular years, the employer guarantees to pay the pension to the servicemen, right? So this comes under defined benefit plan, where the benefit is defined for the future. And that is how it is different from contribution plan, because here the investment risk in defined contribution plan is assumed by the employee. The business or the company is only concerned with contributing to the fund on the monthly basis. Whereas on defined benefit plan, the contribution made on the monthly basis should generate a sufficient return to fund all these pensions that is being due in the future years. This risk is assumed by the employer. Okay. No, you didn't miss anything. We just revised a small point about defined benefit plan. Someone was asking the doubt about it. RJ, if that is the case, there might be an IVR number on Google. So you will search for data trend IVR number, and you can get in the touch with the team, and they will help you out in that case. If you're, I think you are talking about your counselor is not, you are not able to get in touch with your counselor, right? So in that case, call on the IVR number. LMS has not provided computer type notes yet. I had raised, so you mean PDF. I had raised a ticket about it, but I think they didn't get what I am trying to say. So AR, just share your registered email ID in the chat box. I will arrange a call back from there. Now, Nandini wants me to explain about defined contribution plan. When I say defined benefit or defined contribution, this contribution or benefit is with respect to the employer. Here, let's say your CTC for the company is 1,10,000. Your in-hand salary is your salary is 90,000. GV, for that case, you will have to raise a ticket through LMS. And finally, the remaining 20,000 is being contributed to your pension fund. How? 10,000 from your, and your base salary over here is, let's say 1 lakh, or it is also called as gross in hand. Guys, anyone facing issue with the PDF regarding whether it is opening or not opening? So gross savings is 1 lakh. Yeah, KG is facing that issue as well. Just give me a second. I'll ask about it. Just give me a second. Let me just complete this. So CTC is 1,10,000. Gross salary is 1 lakh rupees. In hand salary is 90,000. So 10,000 out of your gross salary goes to your pension fund or goes to your defined contribution plan from your end, and 10,000 out of this is what your employer contributes. This generally happens in case the employer is a private organization and not a government organization. So in this case, employers contribution and your contribution is defined. But so the contribution is defined over here. What I mean by contribution is defined, what you are going to contribute each month in that pension fund is defined. That is why the name defined contribution plan. So MS is saying avoid using sharing the PDF via zip file. Although I am not the one who shares the PDF, That's why it's not opening. Normal PDF should be uploaded. Okay, I'll make sure. Uh, it might not be downloadable due to pirated issue, but it should at least get opened. So I will make sure that I highlight this issue to a respective team who looks care to this issue. So there is a person called Devansh who is associated with all this. So I will highlight this issue to him, and I'll make sure that this issue get resolved as soon as possible. Gratuity is a different benefit. Gratuity is somewhat like a different benefit from normal pension funds. When you spend a particular year with an organization, you have contributed a lot for the growth of that particular organization. And under various acts, under various nation gratuity, there is a provision for gratuity based on the numbers of years that you have. So it is somewhat different from provident. Yes, I will ask him to share derivative notes from LMS. By the way, okay, just give me a second. Let me see if I have missed anything or not. Okay, no worries. If the PDFs, if the if the word made PDFs are not available, then don't worry. It will be uploaded soon. I will make sure that I coordinate with the team, the technical team, and they get it uploaded as soon as possible. Okay. Thanks for highlighting the issue, guys. I'll make sure that it gets resolved. I will highlight this issue with the respective team and make sure that they resolves this issue as soon as possible. Okay, cost of capital. First of all, what is capital? First of all, what is your idea of capital? How many of you have heard this word for the first time? What do you mean by capital? Okay, writing down your understanding of capital, money, cause owner's fund. Okay, money required to run a business. Capital is nothing but funds. Amount required to start a business, amount invested in a business, investments, amount introduced in a business, anything that gives its owner value or advantage. Okay, ownership basically. Apart from anything apart from this. So all of you are correct. Capital is nothing but funds. Funds required to start and run a business. Now, when it comes to capital, basically a form of money which has been introduced in a business, the business can get capital from two sources. One source is equity, other source is debt. One source is equity, other source is debt. If the capital is contributed by the owner in the form of equity, it is basically owner's contribution to the business. It is basically owner's contribution to the business. It means that if you are running your own business and you are contributing your own money to the business, it is, and it would come under the equity section of the balance sheet. On the other hand, if you are borrowing funds, if you are borrowing funds from a third person and using those funds to run your business, look the question that will be on the video, but you have not uploaded the same yet. Okay, okay, KG. When I go in the break today, I'll send that sheet to the technical team and ask them to get it uploaded. Okay, if it has not been uploaded, please raise a ticket about it. Okay. I'll again share the sheet with the team and ask them to get it uploaded. If it is not uploaded, please raise a ticket about it. I'll ask them to upload it as soon as possible and know the reason why it has not been uploaded yet. So debt is what? Debt is borrowing of funds. If you have borrowed money or capital from a third party to run your business, it would be your debt. So your total equity plus total debt comes together to make your total capital. Total equity plus total debt comes together to make your total capital. So basically, when you are buying shares of a company, you are investing to be the owner of the company. And that investment is called equity investment. On the other hand, when we talk about buying bonds of the company, we invest in the debt side of the company. Why? Because bond is a debt instrument, and that is called debt investment. Now, when a person or a company takes loan, when a company takes loan, what do they pay in return to that loan? If the company pays, if the company takes loan or a person takes loan, what do they pay in return? If I ask you for a loan, what you would ask me to give? You would ask me to pay interest and repayment of principal. Talking about debt securities, provider of capital, that is also called investor, one who invests in the debt side, gets interest as an income. On the other hand, on the other hand, the receiver of capital, debt in this case, also called as issuer, one who issues the debt securities, has interest cost. Correct? So if I am taking debt, interest would be an expense for me. Interest is an expense for me. If I am providing debt, interest would be the income for me. No rocket science in this. Crystal clear till here. Okay. So cost of capital is nothing but the cost that business incurs the cost that business incurs to serve its investors of capital. Basically, if I am investing in company A as an equity investor, and if someone else is investing in the same company as a debt investor, the return that company A and company B is obligated, is not obligated, but expected to provide its equity investors is called cost of equity. The returns that company A, here the word is obligated, the returns that the company A is expected to provide to its debt investors is basically interest expense and also called as cost of debt. So are you understanding what is cost of equity? Cost of equity is represented by KE, cost of equity. And cost of debt is represented by KD. Okay. Yes, I'll be very happy to repeat this. Basically, let's suppose there is company A. I have invested in company A as an equity investor. And you have invested in the same company, RK, as a debt investor. So the return that company A is obligated to provide to you, here company A has compulsion to provide this return to you. So the return that company A has and the company A is obligated to provide to you, basically interest that company A is obligated to provide to you is cost of debt for the company. Okay. The return that company A is obligated to provide to its debt holders is cost of debt for the company. Okay. Are you clear with this, RK, so that I can move on to the equity part? On the other hand, if I am investing as an equity investor, then the return that company A should provide to me and is expected to provide to me, not obligated, but expected to provide to me is called cost of equity. So in equity, basically the company doesn't have compulsion to pay back its owners. But in debt, the company has compulsion to pay back its owners. Although company A is managed by its management and the primary objective of management is to maximize its shareholders' wealth. The primary objective of a management is to maximize its shareholders' wealth. So to provide returns greater than the cost of equity is what every management would work for. Okay. Now, this cost of equity part is often confused with return on equity. Return on equity is what? Net income upon total shareholder equity. This is actually the net income that a company generates. Actually, a net income that company generates on its equity. This is actual value. What I mean when I say actual value, these are reported value in financial statements. This is the actual performance of the company. This is return on equity. Cost of equity is what the expected return is. So let's suppose the cost of equity for a company is 15% and ROE is, yes, I will explain again. It is very simple concept. I'll explain again. Just give me a second, Pragati. ROE is 18%. On the other hand, cost of equity is 18%. and ROE is 12%. So what I'm trying to say over here is, in case A, the company was expected, the shareholders of the company was expecting to get 15%, but the company delivered 18%. Company performed better or worse as compared to the estimations or expectations. The company was expected to perform and give 15% returns, and the company actually gave 18% return. So what is cost of equity, Pragati? Cost of equity is the returns that are expected from the shareholders or from the company by its shareholders. Okay, the returns that are expected by the company from its shareholders. ROE is what the company actually gives. So here the company performed better. And when company performs better, whether its share price will increase or decrease. Its share price will increase. On the other hand, the shareholders of the company were expecting to get the return of 18%, but the company gave them the return of 12%. Did company perform better or worse? The company performed worse in this scenario, and that is why the share price will drop in this case. Now, there is something called as intrinsic value. And rather than introducing you to intrinsic value, that is something which has been taken care of in financial modeling and valuation part. Basically, what is valuation? Valuation is nothing but finding out, although this would be repeated again, it would be this topic, this part would be revised again while discussing financial modeling and valuation. But just to give you an idea, what is the purpose of calculating cost of capital, we are discussing this. So if valuation, what is valuation? Valuation is trying to find the right price of the company. Now, if you go on Google and search for which company should I buy today in India or any corner of the world, there are various brokerage houses. These are called sell-side brokers or sell-side investment banks. On the first week of next month. Okay, KG. So there are various brokerage houses which publishes their research report, and you will see Sher Khan recommends to buy Vodafone Idea with a target price of 18 rupees. Motilal Oswal recommends to buy SBI with a target price of 750. So you may see it over here. These are the target price. Now, what is this target price? This is basically, according to the analysis of the various brokerage houses, this is basically the right price for the company. This is basically the right price for the company. Let's say if the current market price of Reliance is 2,700, and according to the analysis of yes, you can call that this recommendation as an entry price, but it is somewhat very different from the entry price. If let's say that again BNP Paribas is recommending the target price of Reliance as, according to the analysis of BNP Paribas and equity researchers in BNP Paribas, the target price of Reliance is coming something around 2,400. So what they will do? They will give a recommendation, sell Reliance target 2,400. So what is happening over here is, that is a downgrade, yes. So what is happening over here is, if current market price is greater than intrinsic value, the security is considered to be overvalued. And if current market price is less than intrinsic value, it is called undervalued. Now, if you might be wondering what is intrinsic value, intrinsic value is nothing but the right price according to your analysis. Intrinsic value is nothing but right price according to your analysis. Now, over here, when Sher Khan told that target price for Vodafone Idea is 18 rupees, according to the analysis of Sher Khan, the target price or intrinsic value is 18 rupees. Here the intrinsic value is 750. Here the intrinsic value is 2,400. Okay. Now, to calculate this intrinsic value, to calculate this intrinsic value, there are various approaches, but basically this is broadly classified into two types. One is free cash flow based approaches. Not all or majority of shares. Yes, Adani trade at a very high intrinsic value or a PE multiple. There are various reasons behind that, because they are associated with various projects which are expected to perform very better in the coming years. And intrinsic value, no one knows the right intrinsic value. Has anyone seen God? No, no one has seen God, right? Similarly, no one knows what is the right intrinsic value. Valuation, if you remember, I told you valuation is subjective. If I try to value a company based on my assumptions, the company could give a different result. If you try to value a company based on your assumption, the company could give different result. And 50 other analysts try to value the company based on their own assumptions, the company or the intrinsic value of that company could give you different result. So valuation is very subjective measure. Valuation is a very subjective exercise. Coming to how intrinsic value can be calculated, it can broadly be calculated based on two approaches. One is free cash flow approach, that is also called as discounted cash flow valuation. And the other one is relative valuation approach. Basically, relative valuation approach is based on ratio analysis. That is something that we will cover while starting with the valuation part, financial modeling and valuation part. But for now, just understand this, that ratio analysis is the base for relative valuation approach. And for free cash flow valuation approach, discounted cash flow valuation is the base. And to understand discounted cash flow valuation, you need to be well aware with the topic of time value of money. So what is time value of money? By first, week of next month, Asha. Everyone is asking when we will be starting with financial analysis and Excel part. We will be starting with the first week of next month. Make sure by that time you have practiced a bit of Excel. That would help you to cope up with the class. Although we are going to cover it right from scratch. So time value of money says that money changes its value Yes, I am going to cover that part. Money changes its value as time passes or time changes. It would be uploaded, GB, don't worry. So it would be covered under financial modeling and value. So time value of money is nothing but money changes its value as time changes. Now, this is every equation of time value of money is based on the simple formula that is present value is equals to future value upon 1 plus r raised to n. 1 plus r raised to n. What do I mean by this? This is present value. This is the amount that I invested today. And this is future value. This is what this amount, let's say $1,000 invested today. This is future value. Future value gives you the amount that this $1,000 will become after a given period of time. Let's say that time is 10 years. So if $1,000 is invested today at 10%, what it will become in next 10 years? To know that, we will have to take this present value and compound it at 10% and push it towards 10 years. So we will be pushing it. Now there are two terms most very much frequently used in finance: pushing and pulling the cash flows. Please try to understand this. Pushing the cash flows, and this part will again be repeated while explaining you. Yes, I'll go to that slide as well, Pragati. Just give me a second. So this is something that we are going to revisit while doing financial modeling and valuation. So if you understand it now, that part would be very easy, a cakewalk for you. So please pay your attention over here. So this slide you were asking for Pragati to show you. Perfect. You can take a snapshot or anything so that and allow me to move ahead. Perfect. Now, when we push the cash flows, what do we mean by this? We have a present value and we want to calculate the future value of it. So something that we invest today will be compounded and we will receive a future benefit of it at maturity. So if present value is pushed to calculate the future value, it is called the compounding effect. So what I want over here is, I want to get the future value of the amount that I have invested today. So future value is nothing but present value into 1 plus r to the power n. 1 plus r to the power n. As you can see, compounding is, while doing compounding, we are multiplying the present value and pushing it further. To push someone, we multiply. To push the cash flows, we multiply. Okay. And to pull it back, if let's suppose I want 10,000 rupees in future, what is the amount that I should invest today, I will have to pull it back to present. So if future value is given to us and we want to get the present value of it, we will be discounting it with a rate that is 1 plus r raised to n. So if we are multiplying it, if present value is multiplied, compounded and pushed forward, we will get the future value. And if future value is discounted or pulled back, we will get the present value. Everyone clear with this? Everyone clear with this? Till here, please let me know if anyone of you have any doubt. Perfect. Now, based on the formula that you can see, present value is equals to future value upon 1 plus r raised to n. Do we suppose to use PV table to calculate this? No, we don't need to use that. Excel has all the functions that we need. So basically what I'm saying, Shrivikash, that if you want to get future value, you will have to multiply and push this present value further. So how will you push it? You will take this present value and push it further. Push it further. How will you push it? By multiplying it with the compounding factor. This is nothing but compounding factor. So you are basically compounding a present value to get a future value. So you are investing 1,000 today and you are not taking any amount in the next 10 years. So what would be an amount available to you in the next, at the end of 10 years? To get that, you will take the present value, multiply it and compound it and push it further to get a future value. So are you clear with the compounding part? If yes, let me know so that I can go to the discounting part. Now, if let's suppose you have a goal that you need $10,000 in next 10 years. So you start a small investment every year to invest in that goal. Now, what is the investment that you should make today? What is the investment that you should make today? No worries, Priyanka, just give me a second. $10,000. Okay. Forex market and gold. R is not the factor, R is rate of return. This complete term becomes the factor. Okay, Ritik. So there is $10,000. So there is $10,000 that you need in 10 years. So make sure, Ritik, you contribute towards the class in terms of knowledge that you have gained over the years of experience. So in the next 10 years, you need $10,000. So what is the amount that you need today to invest? To find that amount, you will pull this $10,000 to the present value terms, and then you will get that amount. So how will you pull it? By dividing it. By dividing it with a discounting factor. So revising everything, summarizing up what we discussed, we started with cost of capital, where we saw that the two sources of capital are equity and debt. The returns that the company is providing its equity holders is called cost of equity. The returns that company is expected to provide its debt holders or obligated to provide its debt holders is called cost of debt. P ratio is something that is related to the ratio analysis part. There, when we will come there, we will discuss about the PE ratio, price to earnings ratio. No, cost of equity is not dividend. What is cost of equity? We will see. We have not discussed it yet. Basically, consider that returns that is expected by owners of the company. No, market cap is not cost of equity. Market cap is completely different term. Market cap. What is market cap? Market cap is basically if you want to buy the all outstanding shares of the company, If you want to be the 100% owner of a listed company, then you need to pay market cap. That is market cap. We will discuss what is cost of equity. Don't worry. We have not, let's not make assumptions from now. I'm just revising. Basically, all the shares that would be required to buy the company, to get the 100% ownership of the company, will come under market cap. So for equity shareholders, it is cost of equity, and for debt holders, it is cost of debt. Okay. Then we saw the concept of intrinsic value, that what we feel is the right price of the company. We saw to find this right price, there are two broad approaches: free cash flow approach and relative valuation approach. Relative valuation approach is based on ratio analysis. Free cash flow approach is based on discounted cash flow valuation, that is basically an application of time value of money. Moving forward, we saw that how can we compound and discount terms? How can we calculate the future value of something that is present in today's value term? How can we get the today's value of something that is expected in coming future? Now, cost of capital is used majorly in free cash flow valuation approach. That is also called as discounted cash flow valuation approach. That is also called discounted cash flow valuation approach. Now, what is discounted cash flow valuation approach? It works on a very simple principle, that intrinsic value, or should be price, of the company, of the security or company, is nothing but the present value. Yes, weighted average cost of capital is part of discounted cash flow valuation. The intrinsic value, or should be price, of the security or company is nothing but the present value of all its future cash flows. All its future cash flows. So what we will be doing is, while making a DCF model, we will be forecasting that what are expected cash flows company is going to make in year 1, 2, 3, 4, 5, and infinity. We will be finding or projecting the expected cash flows that company is expected to make in year 1, 2, 3, 4, 5, and up till infinity. When we have these future cash flows, we will pull these cash flows back by doing what? By doing compounding or discounting. By discounting it and getting the present value of those cash flows. Sure, someone wanted to see the last slide. This is the last slide. This is the slide that you wanted to see, Anshuman. Okay. Now, to discount, as we saw, to find present value from a given future values, we need 1 plus r raised to n, correct? We have n, that is year 1, year 2, 3, 4, 5. future value is something that we are going to calculate using the model, but the R here, the rate that is been used to discount all these future cash flows is nothing but cost of capital. Are you understanding the significance of cost of capital? How significant is this cost of capital to you? Because a slight change or slight variation in cost of capital can impact the decision of your investment. And if you are an analyst who is covering that particular company, it could impact millions of dollars of flow in that particular company. Free cash, I am coming to that as well. So here we have future cash flows, and we discounted those future cash flows. We discounted those future cash flows to get the present value, that is nothing but the intrinsic value of the company. That method is called discounted. Here we are discounting it, right? Discounted future cash flows, discounted cash flow valuation. So future cash flows are discounted to get the present value, that is discounted cash flow valuation. Now, in a discounted cash flow valuation, there are basically two types of cash flows. The two important aspects of a discounted cash flow valuation are, the word itself says discount rate. Discount rate is what? Nothing but cost of capital. And what could be the next important element in a discounted cash flow valuation? The next important element is nothing but cash flows. The name itself says discounted cash flow valuation. Discount stands for discount rate. Cash flow stands for cash flows. So discount rate we will come to discount rate. That is all we will be discussing in the module cost of capital. Yes, that is the process of discounting as well, AP. So when we talk about cash flows, I am coming to discount rate, but just allow me to spend 2 minutes on the cash flow part. So when we talk about cash flows, there are two types of cash flows. One is free cash flow to equity, and the other one is free cash flow to firm. What is free cash flow to equity? Basically, only those cash flows that belong to equity shareholders. That is free cash flow to equity. We will see how free cash flow to equity is or free cash flow to firm is calculated. Either free cash flow to equity or free cash flow to firm is calculated. It means that either we will calculate free cash flow to equity or free cash flow to firm in financial modeling and valuation analysis. Financial modeling and valuation classes that we are going to cover starting from first week of next month. So FCFE, free cash flow to equity, the name suggests free cash flow available to equity shareholders. Free cash flow to firm, a firm is nothing but the summation of equity plus debt, both. Are equity holders the only segment of the firm? No. When we talk about the firm is made of both equity and debt holders. So the cash flows available to both equity and debt holders are called free cash flow to firm. These are also called unlevered cash flow. Unlevered cash flow. FCFE is called levered cash flow. Okay. Now tell me, guys, if free cash flow to equity is the cash flow that is being used, which belongs to equity shareholders, the discount rate should also belongs to equity shareholders. And what is the discount rate or cost of capital for equity shareholders? Cost of equity, correct. And when Free cash flow to equity, cash flows available to equity shareholders is discounted at a discount rate available to equity shareholders, that is cost of equity. What we get? What we get is equity value. On the other hand, when free cash flow to firm is discounted at the appropriate discount rate, what would be the appropriate discount rate for free cash flow to firm? It would be WACC, weighted average cost of capital. So you want me to show previous slide? Just give me a second. This free cash flow to equity is discounted at cost of equity to get equity value. We will see what free cash flow to equity is. We will see what equity value is. But the focus should be, for today, the focus should be on the discount rate, that is cost of equity. So what I'm trying to say is discounted cash flow valuation comes with two broad terminologies. That is, the two important aspect of a discounted cash flow valuation is discount rate and cash flows. When we talk about discount rate is nothing but cost of capital. When we talk about cash flows are of different types. Firm is basically the whole company. So cash flows, when it comes to cash flows, there are two broad types of cash flows: free cash flow to equity and free cash flow to firm. Free cash flow to firm comprises of both equity and debt holders. Free cash flow to equity comprises of only equity holders. Free cash flow to equity is discounted at a discount rate of cost of equity to get equity value. But if you are getting confused, don't worry, because this is going to be practically explained through models when we will be doing financial modeling and valuation. But what you should understand is cost of equity. And when free cash flow to equity is discounted at cost of equity, we get equity value. On the other hand, the next important cost of capital is WACC, weighted average cost of capital. This is nothing but cost of capital for the whole firm. And when the free cash flow to firm is discounted at WACC, we get enterprise value. Again, a new term, enterprise value. Don't worry, this will also be explained in detail during financial modeling and valuation part. But the purpose of the whole cost of capital module is to understand how cost of equity is calculated and how weighted average cost of capital is calculated. So don't worry if you are getting confused between what are these terms: FCFE, FCFF. If you have understood it, it is very well, very good. What is equity value? What is enterprise value? All these terms are going to be covered in much more detail, but it was the need of the hour to discuss all these terms to make you understand the significance of cost of equity and weighted average cost of capital. Okay, so we will take a short 5 minutes break, and after the break we will be starting with the heart of the module, that is calculation of cost of capitals, how cost of capitals are actually calculated. Okay, so just go on a 5 minutes break, guys, but make sure that you are right back. Make sure that you are right back. Okay. Yes, cost of equity is also used in dividend discount model as well. Because again, dividend is something. The schedule will be uploaded. The schedule will be uploaded. Don't worry. Okay, so let's go on a 5 minutes break, but be right back in next 5 minutes, guys. We will be starting soon. KG, I would request you to raise a ticket about the document that you wanted me to give you. So please raise a ticket about it. So that is very personal, KG. So that would deviate the purpose of the class, that we the point that we are going to discuss today. So I would request you to raise a ticket about it, and I will surely give you the insights about it. When going to start, because as the syllabus is more, usage of Excel is starting. Don't worry, GB, don't worry. We will be starting it by the first week of next month. Yeah, there would be. That is the part of financial modeling uh, module. So there you will get to practically make a model, DCF model right from scratch. Okay, so let's start. Let's start. Starting with the first one, that is cost of equity. Shall we start, guys? Is every one of you back? Guys, are every one of you back? Perfect, perfect. I am receiving messages that some of you are back. This is cost of equity. Cost of equity is are returns to whom? Are returns to whom? These are the returns to. These are the returns to equity shareholders. Let's say, let's say Ashish is a startup owner. Ashish has founded up a startup, and Ashish wants to raise investments. So Ashish is a founder and he wants to raise investments. Ashish's company has recently been listed in the stock exchange, and he wants to raise more funds to expand its business. Now, Ashish wants to accumulate $100 million. Ashish wants to accumulate $100 million. So he has decided, based on his analysis, that equity would be the ideal form of raising capital for him. Raising this 100 million through with the help of equity would be the ideal thing to do for his company. Now, if many people, or let's say me being the representative of all these people, reach out to Ashish that Ashish, I heard that you are raising 100 million funds. I could provide you with that 100 million of funds, but what would be the return that you would give me? What would be the return that you would give me in these on these 100 million of fund? So Ashish told that what is the risk-free rate? Ashish asked me what is the risk-free rate. I told him that the risk-free rate is around 5.9%. That the risk-free rate is 5.9%. So Ashish told me that if sir, if you would have invested in if you would have invested in government bonds or government securities, you would have got 5.9% return. Expect the same return from me as well. I will provide you with 5.9% return. So, sir, please invest in my company and I will provide you with 5%, 5.9% of return, like what government securities was providing you. Everyone with me till here? Everyone with me till here? Please let me know. Please let me know. Otherwise, once we are done with this whole part, then it would be very difficult for me to explain this again. Everyone with me till here? Okay. Now, risk-free rate means the rate of investment of the rate of return from government securities. So, what is risk-free rate? If you are investing in a risk-free security, risk-free rate is nothing but return provided by risk-free security. Returns provided by risk-free security. What is the risk-free security? Basically, government security. If government fails to pay you back, government has the power to print more currency and give you your money, right? So basically, when you invest in government security, you assume those securities to be risk-free, although it is not, but still government securities of a particular nation are considered as the risk safest asset for that nation. That is risk-free security. Okay. So basically, a founder Ashish wanted to raise 100 million fund. I came to Ashish and said that I will provide you with 100 million fund, but what you will give me? Ashish said that if you would have invested this in risk-free asset class like government securities, you would have got 5.9% return. So I will provide you, sir, with 5.9% return. Feel free to invest 100 million of your funds to me. Okay. I am repeating again what has been discussed. We are discussing cost of equity. No worries, Ritik, I am repeating again. Please pay your attention. Please pay your kind attention. So there was a founder. There is a founder who is named Ashish. Ashish wants to raise 100 million funds from the market. And to get that 100 million fund, I reached out to Ashish. I told that I have 100 million funds to fund you. But what is the return that I can expect by investing in your company? Ashish told me that, sir, if you would have invested this 100 million funds in a safest asset class worth 5.9%, like government securities, if you would have invested this 100 million of funds in a risk-free asset like government securities, you would have generated 5.9% as returns. So if you want me, if you want to invest in my company, I can also provide you with that 5.9% of return. If again, explaining the point what Ashish said, if you would have invested in a risk-free asset, the risk-free asset would have given you 5.9% return. Investment in my company and I will give you 5.9% return. because that is an example of risk-free asset. Because it is backed by government power of taxation and printing money. So if you invest in government securities, there are little to no chances that your money will sunk or your investment will go zero. Okay, that is why we are considering government securities. That is basically an example of risk-free asset. Ashish said, if government security is providing you 5.9% return, I will also provide you 5.9% return. Please invest in my company. I said, my dear Ashish, if I would have been happy with 5.9% return, I would have invested in government securities, right? If government securities is also providing 5.9% return, I would have straight away invested in government securities. I am investing in your company. I am investing in your company, and your company comes with a higher risk, a much higher risk as compared to government securities. Why? First of all, government securities are debt securities. Debt holders get priority of claims in settlement. Basically, debt is less risky than equity. So if I am investing in your company as an equity holder, I don't expect me to be happy with 5.9% return. Fair enough. Fair enough. Because government securities are debt securities. And if I would have been happy with 5.9% return, I would have straightly invested in the safest debt securities. Here, I am assuming two risks. First of all, investing in equity. And after that, in all the equity options that I do have, I'm investing in your company. So you will have to raise your return in such a way so that it gets compensated for the risk that I am assuming. The returns, what I am saying to Ashish is, the returns should be compensated for the risk that I am assuming. The returns should be compensated for the risk that I am assuming. Am I correct in this? Is my stance correct? Shall we move ahead if you have understood everything till now? So what you said, Ashish said, okay, sir, I got your point. And I completely agree with you. Ashish says that what is equity market giving you? What is equity market returns? What is equity market returns? That is, what is return from the market? I said returns from the market is 14%. Let's say it's 14%. Ashish told, sir, I agreed to give you 5.9% return. Now, excess, what is 14% minus 5.9%? It's basically 8.1%, 9.1%. Correct? No, it's 8.1%, 8.1%. Okay. 14% minus 5.9% is 8.1%. Ashish says me that, sir, I already gave you 5.9% return. That is return from a risk-free asset. I will give you the excess return that market gives. It means that I will give you 8.1% extra return as compared to risk-free asset, so that you get the 14% return, the same return that you said what market gives me. So if risk-free asset is giving me 5.9% return, Ashish is giving me 8.1% extra return, I would be able to generate the returns that market is generating. Ashish asks me, sir, are you happy now? Are you happy with the returns that I'm giving you? Should I be happy with this? Should I be happy with this? The returns that Ashish is giving me? Think about whether you would be happy with this. What should be the argument or negotiation strategy I should say to Ashish so that this is a fair deal? Think about it. Every one of you got this, whatever has been discussed till now. Everyone, so that I am moving to the next part of the conversation. Guys, please reply. Every one of you got this? Yes. Very good, GA. I tell Ashish that Ashish, thank you that you have given me risk-free rate as return. Thank you that you have given me 8.1% return. That is extra return. I will explain this, Swapnil. I will summarize everything. Let me just get done with this and I will summarize everything. I will get extra return other than the risk-free rate what market gives. So this is basically RM minus RF. RM was 14, RF was 5.9, and this is 8.1, which gives me a total return of 14%. I will tell Ashish that Ashish, my dear friend Ashish, if I would have wanted just 14% returns, I would have invested in Nifty. I would have invested in Nifty. That is the benchmark for the market. I would have invested in market. I have 100 million of funds. I could have easily replicated the portfolio for Nifty, or simply I would have invested in Nifty ETFs, exchange traded funds. So if I would have invested in Nifty, I would have got BOD. What is BOD? Benefit of diversification. If I would have invested in Nifty, I would have got benefit of diversification. Ignoring that, I am investing in your company, which seems to be more risky, than the overall market. So if I am taking more risk as compared to the overall market, I should get more return as well. So this RM minus RF component will be multiplied by beta to incorporate that riskiness. So Swapnil, if you are not getting anything, I am just summarizing the whole story that we are discussing from last 15 minutes. That cost of equity, if you are an equity investor, the return that you would want to get from the company is risk-free rate plus excess return from the market, that is RM minus RF. It is called risk premium or market risk premium. And since you are investing in a particular security which is higher or lower volatile than the market, what I mean by volatility is higher or more risky than the market, in that case, that risk premium will be multiplied by beta. Now, beta can be greater than 1. Beta can be less than 1. I will come to beta and explain what actually beta is. But please let me know that whether you have understood this cost of equity with a logic, that how basically this cost of equity is calculated. Are you guys comfortable with this equation? Swapnil, do you want me to re-explain this? Okay. Swapnil, so if you will be investing in my company, I have not explained beta yet. I will come to beta. I have not explained beta yet. Swapnil, I am explaining this for you again. Please try to understand. Let's suppose even Kriti is asking me to re-explain. So there are two people who are asking me to re-explain. So I am re-explaining this. Please be with me, guys. If if I want investment, if I want you to invest in my company as an equity holder, I should provide you with the adequate returns based on the risk that you are taking. Is it clear that the person who is taking more risk should be awarded with a higher return? This is the basic idea over here. Guys, is this clear? BS, KV and SM. Perfect. So the return that I would expect is at least the risk-free rate. So if risk-free rate is 4%, I would want 4% return. If Nifty or the market is giving 14% return, I would want that 14% return at least. So this 4% plus 10% gives me 14% return. But am I investing in Nifty or am I investing in one particular security? I am investing in that one particular security. So if 4% is the return given by the risk-free asset and 10% is the extra return that is called the risk premium or market risk premium, it is basically what is premium? Premium over here means nothing but the extra return that you get return from market. RM stands for return from market. Extra return that you get for assuming more risk. So one who is a debt investor gets 4% return and one who is an equity investor gets 15% return. This equity investor is getting 11% extra return. This 11% is nothing but the premium. Why premium? Because equity is highly risky than debt. That is why the equity investor should get a premium as compared to debt investor, and that is this 11%. How is this 11% derived? Return from equity market minus return from risk-free asset. Return from equity market minus return from risk-free asset. So that is RM minus RF. Are you guys clear with RM minus RF? Are you guys clear with RM minus RF? SMU. Let's suppose SM. You are investing in equity and you are getting 15% return. And if you would have invested in a risk-free asset like debt or government bonds, you would have got 5% return. You are getting this difference of 10% return, extra 10% return investing in equity. Why are you getting this? Why are you getting this extra 10% return? Why are you getting this extra 10% return? SMPM, tell me, why are you getting this extra 10% return? Because of the extra risk that you have taken. Equity is more risky than risk-free asset, right? So this extra 10% return is what? This extra 10% return is nothing but the premium that you receive in returns for assuming the extra risk. So what is the formula for this premium? What is the formula to get this calculate this extra return that I am talking about? What is the formula to get this extra return that you call premium? What is the formula for calculating that premium? The formula is RM minus RF. RM minus RF is the premium. Okay, understood now? The significance of RM minus RF? Everyone? Have you guys understood this? RF is nothing but return from government securities or a risk-free asset. If you invest in that asset, the returns that this asset is giving you is basically risk-free. That is RF. Okay. RF will be debt. Government securities is nothing but debt securities. Government securities are nothing but debt securities. RM is return from market. RM is return from market. But if 5% is the return by the risk-free asset and the premium is 10%, you only get 15% return. That is the return from equity market. But instead of investing in equity market, you are investing in one particular part of the equity market. Instead of investing in equity market, you are investing in one particular part of the equity market. So the risk of this particular part should be compared with the risk of the equity market. And based on that, the returns should be determined. And how will we compare risk? Risk will be compared based on beta. So beta is a measure of systematic risk. I have not explained beta yet, but if you are completed with the logical understanding, yes, that is the need of the hour. I'll come with the numbers as well. But first, I want you to be comfortable with these terms. And surely by introducing numbers, you will be crystal clear with the concept. This is what I'm aiming for. So are you clear with RM plus RM minus RF part? I have not came to beta yet. First, let me get clear assurance that every one of you are clear with this part, RF plus RM minus RF part. Are every one of you clear with this part? Perfect. Then the formula was RF plus RM minus RF into beta. There are two RFs written. These two RFs are same numbers. They are no different numbers. They are same numbers. This is cost of equity. And this equation is called capital asset pricing model. CAPM. This equation is called capital asset pricing model. Now, my friends, coming to beta. Why this name capital asset pricing model? Because this model, when you calculate the cost of equity using this model, you discount a future cash flow and try to come up with the fair price of that particular asset. So based on the capital structure, based on the capital or the capital that you have invested, cost of equity would be the return that you will generate. Based on that, you are trying to find the fair price of that particular asset. This is incorporated by this model. This is why, that is the reason why capital asset pricing model. Now beta, in simple words, beta measures risk. What is risk? Risk is one component of risk is, one explanation for risk is volatility. Basically, an asset which is more volatile is considered to be more risky. If an asset is more volatile, it is considered to be more risky. Okay, so beta measures that volatility. Now, if the formula for beta is, if The formula for beta is change in stock prices upon change in market price. Change in stock prices upon change in market price, and beta is coming towards 1.5. For example, beta is 1.5. It means that if the stock is moving by 1%, if the stock is moving by 1%, the market will be moving by 1.5%. Market is more volatile. Sorry, stock is more volatile than the market. Stock is 1.5 times more volatile than the market. If the market is moving by 1%, stock is moving by 1.5%. What I'm saying is I'm giving you the interpretation of beta. Interpretation of beta is change in stock price as compared to change in market price. The interpretation is change in stock price as compared to change in market price. So let's say if the stock has changed with 2% and the market has changed with 1%, then the beta is 2. What this means? It means that whenever the market moves by 1% on an average, the beta moves by 2% on an average. Okay. So higher the beta, higher the risk, and higher the risk, don't you think higher should be the cost of equity? Okay. Without doing further ado, consider this question and try to solve this yourself. The risk-free rate is 6%. RM is 14%. Beta of a security is let's say 1.5 in scenario A and 0.8 in scenario B. I want to, for let's say 1.5 is for company A and 0.8 for company B. RF and RM will be obviously same because the company is being operated in the same economy. And you need to find cost of equity for company A and cost of equity for company B. Take your time. I have received different responses. Priyanka says 12 is for A. PP says 18 is for A. 6.4 for B. 12.4, 18%, 12.4%, 21, 11.2. Various different answers. Take your time and try to solve this. Remember the formula would be same. RF plus RM minus RF into beta. This would be 18%. And again, the formula would be same over here as well. RF plus RM minus RF into beta. Here beta would be of beta A. Here beta would be of beta B. Here it would be 12.4%. Now, how many of you got this answer wrong? How many of you got this answer wrong? How many of you got this answer wrong? SM, okay. Shall I solve this for you? Okay. Shall I solve this for you? Okay. This is company A. The formula is RF, that is 6%, plus RM minus RF, 14 minus 6, and beta is 1.5. 14 minus 6, 8. 14 minus 6, 8, multiplied by 1.5 gives you 12. 12 plus 6 is 18. So this is 18%. 14 minus 6 is 8. 8 into 1.5 gives you 12. 12 plus 6 is 18%. Simple. Pretty much simple. Using basic board mass rule. Correct. Next. 6% plus 14 minus 6 into 0.8. 14 minus 6, 8. 8 into 0.8, 6.4. And 6 plus 6.4 gives me 12.4. Now, the observation that you as an analyst should make is company A has a beta less than 1. That would mean company A is less risky as compared to the market. Company A is less risky as compared to the market. Why? Because when market moves by 1%, company A, if market falls by 1%, company A's stock prices only falls by 0.8%. Okay. When market moves up by 1%, company A stock price only moves up by 0.8%. So on an average, company A is less risky as compared to the market. Sorry. Company A's beta is 1.5, right? I'm talking about company B. Sorry. Okay. Company B, company B's beta is less than 1. It means that company B is less risky as compared to the market. Therefore, see the returns that company B is giving is also less as compared to the market. Market gave you 14% return and the company is giving 12.4% return. Why? Because company B is less risky as compared to the market. On the other hand, the next observation, just give me a second, guys. Okay. So what I was saying is, RK says, yes, beta is a measure of systematic risk. Now, RK says, who decides beta? Beta is not decided but calculated. Calculated on how it is calculated? Based on change in stock price and change in market price. So when we will go for the selection of stock and market, when we will go for making the financial model, we will see how beta is practically calculated. Okay, RK? We are going to actually calculate beta and see how beta is actually calculated. Now, since I'm done with 20 slides, the clear observation that I wanted to make over here is, if beta is less than market, stock is less risky than the market. Therefore, cost of equity will be less than return from market. On the other hand, if beta is what is into 1.5? Yes, GV. Just give me a second, guys. Let me share this sheet with you since I will have to delete the slides. Guys, please check whether the chat is available in the chat box or not, those who have joined from PC. Please check whether the chat sheet is available in the chat box or not. Fair enough. Now, let me just delete all the slides, or at least 5 to 10 slides. Anupriya, probably you might have joined through mobile phone, and that is why the sheet might have not been showing up to you. Don't worry, the sheet will be uploaded on the LMS. Okay. So the clear point that I wanted to make over here is, if beta of a company A is greater than market, greater than beta of the market. And what is beta of the market? Always remember, always and always remember, please make a note with star raised to infinity, that beta of the market is always 1. Beta of the market is always 1, the constant number 1. If beta of security A is greater than beta of the market, it would mean company A has higher risk as compared to the market. So I wanted to ask if you delete the slides in the middle of the class, and if someone after the class downloaded from the LMS, then yeah, they will get the sheet. They will get the sheet. So GV is asking if I have deleted all these slides, and if I upload these the same file on the LMS, will the file uploaded on LMS will be the deleted one or the new one? So I will update both the sheets. I will make sure that the guys update both the sheets from the technical team. Company A, if beta of A is higher than beta of the market, it would mean company A has higher risk as compared to the market. On the other hand, that would mean the return that company A should give should be higher than the return of the market. On the other hand, if beta of B is less than 1, it means that company B is less risky as compared to the market. And if company B is less risky as compared to the market, then cost of equity for company B would be less than return from market. The return provided by company B would be less than return from the market. With this, we are done with one of the discount rate, that is cost of equity. What was the next discount rate that we wanted to talk about? Anyone remember? What was the next discount rate? Yes, the next discount rate was WACC, weighted weighted average cost of capital. Weighted average cost of capital. The formula for weighted average cost of capital is weight of equity into cost of equity plus weight of debt into cost of debt. That is weighted average cost of capital. Now, so in the last point, we simply discussed on the given logic that higher the risk, higher the return. If beta of A is higher than the beta of market, that is 1. If beta of A is higher than 1, it means that the security is more risky than the market. And if risk is high, the return should also be high. So the cost of equity would be greater than return from the market. On the other hand, if beta of B is less than the market, it would mean that company B is less risky than the market. If risk is less, return should also be less. So cost of equity for company B would be less than the return from the market. This is what the last point was made. Clear, Anshuman? Perfect. Now, how many of you are comfortable in calculating weights? How many of you are comfortable in calculating weights? If not, just giving you the idea that weights are nothing but, if weight is of equity, weight of equity is nothing but percentage of equity in total capital. What is weight of equity? Nothing but percentage of equity of total capital. Percentage of equity in the total capital of the company. What is weight of debt? Percentage of debt in total capital of the company. Now, between equity and debt, there is another security called preference shares. So not every company issues preference shares, but if a company has preference shares, weight of preference shares multiplied by cost of preference shares would also be the part of weighted average cost of capital formula. But not every company, very few companies in the world, I can't say very few, but so very less companies as compared to equity raising companies and debt raising companies raise preference shares. Okay. So basically, ignoring the impact of preference shares, we will see what preference shares is in cash equities class. For now, let's just ignore the impact of preference shares. Let's say if 100 million is the total capital and 30 million is raised by equity at 14%, 70 million is being raised by debt at 10%. Can you guys calculate and give me weighted average cost of capital? What would be weight of equity? 30 divided by 100 into 14% plus weight of debt 70 divided by 100 into 10%. 30% of 14 will give me 2.8, 3.8, 4.2. And this would be 7%. And the answer would be 11.2%. Always remember the cap of weighted average cost of capital is cost of equity and floor of weighted average cost of capital is cost of debt. And weighted average cost of capital would be between cost of equity, would be a value between cost of equity and cost of debt. If you are getting a value higher than cost of equity, then your weighted average cost of capital is wrong. If you are getting a value lower than cost of debt, lower than cost of debt, then your weighted average cost of capital is wrong. So this was about weighted average cost of capital. One important thing that we need to highlight before we end the session is cost of debt. Cost of debt is nothing but, when we talk about cost of debt, there are two types of cost of debt: pre-tax cost of debt and post-tax cost of debt. So there is a pre-tax cost of debt, there is post-tax cost of debt. Tomorrow, when we will be starting with the session, what we will be doing is we will be solving few sums on WACC. We will be solving few sums on cost of equity as well. And we will be seeing what is pre-tax and post-tax cost of debt. Okay, so let me share this sheet with you. Yes, that is the formula AP, but I will have to explain with some logic. That is why I'm not introducing it yet. So guys, the new sheet COC2 is available to you. Is the new sheet available to you? Perfect. So that was all it from my side, guys. I hope you enjoyed the session. We will see each other tomorrow. Make sure you revise what is covered in today's class because this will be useful in future as well. I want written notes of the classes. If you have joined from the mobile phone, probably you might have not received it in the chat box, but that will be uploaded on LMS. Thanks a lot, guys. Thanks a lot. Those who have joined from mobile phone won't be seeing the message in the chat box, but it would be uploaded on LMS. So don't worry about it. Thank you, guys. Thank you so much. See you again tomorrow. Bye-bye. Have fun. For revision, you can watch the lecture again or go through the written sheet that will be uploaded in the LMS by tomorrow morning. Good night, guys. Good night. Bye-bye. Have fun. Take care.